What's going on, Chris here? Notice you're big on the investment in stock game. Well, you're misinformed. I'm not big on the investment in stock game. I'm a trader, but they relate to stocks and investing in some way. I just started getting into it last year. I see stock prices are starting to trend down in general. Well, after 6 weeks of down weeks, yeah, you'll notice. Have any tips of specific companies you'd like to purchase this year? Nope. I. So short answer. This is. So there's two ways of looking at the market. One is more. Oh, we want. I guess. We'll expand this. Oh, well, just the place where we're gonna draw. Two ways of looking at it. Oh, that's not. We'll do a line. There we go. Can't screw that up. There we go. There's a bottom down, a top down, and there's a bottom up way of looking at it. And this one's like, looking at the business health, and then this one's looking at the health of economies, basically. And just where's everybody's money going? And right now, I'm more on the top down. When we hit a low, it's more bottom up. I don't think we've hit a low. I think we're on our way to hitting the recession because the 2 and 10 year inverted, and the 2 and 10 has only been wrong one time, and 6 to 24 months from when the inversion is when the recession hits. So if the 2 and 10 year bond inverted in April, we got some time for it to come our way. And I have an indicator that tells me kind of targets for the low side, and this is the S&P 500 futures, and we got like a untouched weekly pivot here. It's if we look at this one, it came back to touch it, and we could touch all the way to this Corona nuke low, and that's a possibility. Like here, when we were sideways for I don't know how many years, I think that's a decade. This was naked or untouched when it went all the way up here, and then it came back and it touched it. This one doesn't count. It touched it a couple times, but this one was a naked one, and it came back and touched it. And here, this one was naked for the most part, and it came back and touched it. So the same logic applies that we're going to come back here. And we could have another one of these right here. We could have another one of these. It's like a sideways decade. It looks like 404 days. Yeah, a sideways decade. So we could have another one of those. And because we can have another one of a sideways decade, I don't see like the huge need to invest when we're all the way up here. We're above halfway. Halfway would be at like 3,400 or 3,400. And that's a good place to buy in the short term, and that's more of like a trade to me. And that's kind of why it's more efficient for me to make money trading than it is to buy and hold stock. I mean, to hedge risk over the long period and prevent more loss, it makes more sense to invest. Depending on who it is. Like if you have skills in trading, you can make money. If you don't, there's a high chance you'll lose money because it's on leverage, and you can actually go to zero when you trade. In investing, you can not go to zero. You could lose money, but you can't go to zero. And if you hold over a long period of time, you could you won't go to zero. You'll come out on profit. There's a higher chance that you'll come in profit. What percentage that will be, who knows? But as a place, like I think the question was like, purchase this year. I'm not gonna purchase anything this year because the 2 and 10 year inverted, and it's only been wrong one time, and I'm gonna at least wait 24 months before buying. And so whether it's this year or next year, I'm waiting for us to go to a target. Not saying that it will, but there's a high probability that we could see the Corona nuke low, and that might be during when we get a recession, and I'll probably be a buyer. I'm going to use probably a value investing kind of screener called Ticker, and assess if this company is going to ask myself the question, is this company going to be around 50 years from now, 30, 40, 20 years from now, and then see how the health of the company is. Do they have a lot of debt? Do they have a lot of equity on hand? Are they increasing in income or equity month over month or year over year? And it'll be a little hard to judge that going, once we hit the recession and the recession low. But, that's kind of just how I would do it. I think value investing is great, especially when we're near a low. But as far as right now, I'm not looking to purchase anything this year. It's just better to save and stockpile money for when that time comes of the recession. And to invest that way, where you just wait for the 2 and 10 year inverts, and then you wait 6 to 24 months, I think it's a fantastic strategy of when to invest. But teach their own. There's different strategies out there. Dollar cost averaging. There's the averaging down method, and I like the down weekly closes, down quarterly closes, and you could put a ratio between that fast and slow kind of distribution or adding to the portfolio. But and one of the things I really don't like about investing is how to forecast growth. Like where you think this is going to be down the line. Like a lot of people like to show those graphs of just, if you bought Google back when it was in its beginning to where it is now, like that's nice because you're looking at the past and it looks very ideal. But when you're looking at the future, it's so hard to forecast something like that. It's ridiculous kind of how hard it is. And that's kind of just the things I don't like about investing. If you were to build your own portfolio, you're coming at it with a bias because you're going to pick companies to screen that you like, and then out of the ones you like happens to be in sectors you like, and you already have a bias. The data is already tainted because of this process, because you're picking based on what you like, and you have no idea if there's more growth or the amount of growth or the growth compared to another sector, and if you're going to come out on top or if you're going to be able to maximize the growth in 10, 20, 30, 40 years. And for example, we're in a contentious phase of IWD versus IWF, which is value versus growth stocks. And there's the value-based analysis, and then there's like the value stock, value companies, and those are just basically defensive companies. Value companies are usually banks. They're in oil, or they're in healthcare, things like, or materials or staples, and it's more of a defensive kind of way of looking at things. But yeah, like say you had a favoritism towards tech, and we happen to go through 10 years of just value pumping and action because of like the inflation or whatever, or the war, well then you were, like the person who picked tech was biased in their data to begin with, and they missed out on all the gains because it all went to oil and banking and healthcare and uh, whatever, like materials and staples. So you could be, you'd be like, oh, but I did the value based analysis. Well, it's not good for forecasting growth. It's just only good for preventing you from losing money. And that's kind of just where I don't, what I don't like about it. You could, um, so I guess like if it, you had to like narrow down the problem, you would have to assess when growth and when value is going to shift, and then assess also when things are going to hit a recession, when we're getting near a low of when to enter and put in your money, and then getting that. But that's of course just me explaining the difficulty of the problem with investing. I just like buy the VOO or VTI S&P 500 deal and then just buy it at the bottom. Like why go through all that trouble and then get some stock picks or just some things that you think there's high growth in, and put it at 1% in all of them, and then just see what increases the most or what grows the most, and what's the loser, what's the winner. And because you put it at 1%, there's not too much of a risk, and you're able to just stay nimble in some way. And depending on how things turn out, you could increase or decrease. You could do a rebalancing quarterly, yearly, and you'll be in good shape. And I like that risk premium harvesting kind of deal. It's more of like what a quant would do, quant investor. But that's kind of why I bought Aikido Finance. So this is like my solution to just the complexity. Aikido Finance, they build portfolios based on factor investing, and they're able to narrow down, instead of 500 companies, a little bit smaller, and we're able to just kind of click the easy button for instead of doing the research and ticker. Aikido Finance, it's like the easy button. It's done. Like you just click on just kind of what you want, and then you just set and forget it. And it does. It can rebalance the portfolio for you, and I like something like that. It's kind of like a quick hand kind of deal, and you can optimize for Sharpe ratio, quadratic. I forgot what it is, or minimum volatility. You can optimize the percentage weightings based on these things. I think it's maximum quadratic utility. That's like the highest growth depending on something. I don't know, but Max Sharpe is a popular one of rebalancing. But yeah, so and that's kind of just the whole investing area in a nutshell, and just how complex it is. I almost think creating your own portfolio is more complex than trading. That's my thoughts. Talk soon.